Self-storage, it's a great asset class because it's simple, it's straightforward, it's not overly complicated to run or to manage. It can be run remotely, managed remotely. You can use technology to manage the tenants and to manage camera system and the gate and all of that, right? It's not a science. I had squatters. I never got paid rent. I looked at the money. I think I ended up losing about $30,000 on the property. I sold it and just got rid of the headache, right?
What a concept. High quality product attracts high quality customer. Welcome again to Real Estate Development Land to Legacy. This is part 2 of my conversation with Sean Graham. I recently interviewed him and we talked about 2 big subjects. One has to do with cost segregation and another is focused on self-storage, where he invests very actively. About half the conversation was about cost segregation, about half of it was about self-storage. So I decided to split it up into 2 episodes. If you have not heard the cost segregation topic, please go back and listen to it now, where I introduce Sean and where he talks about this super cool concept. If you haven't heard about cost segregation, it's going to blow your mind. It's basically a way for real estate investors to minimize their taxable income by using depreciation. Totally legal, by the way. And if you want to learn about self-storage, carry on. Sean is going to tell you everything you need to know about it. We're going to skip the intro and jump right into it. So here we go. Real estate development. And so you knew all that. It sounds like a fairly complicated thing that only folks like yourself with experience know. And then you said, I want to do self-storage.
Yeah, more the opposite. I was in the CPA world, I was in the tax world, and then I got the real estate bug. I really fell in love with real estate. I was building up a rental portfolio on the side, and then I got into self-storage full time and everything, syndicated some deals. So I really get it. I understand it. What idea is to minimize your taxes, to not pay like federal income tax. That's the idea, right? It's like to do it to get your taxes down to zero. That's what the IRS code incentivizes you to do. It's just to keep investing in real estate. And there's a lot of tax benefits with that. On the other side, the tax side, it's like, well, you don't want to go through an audit. You don't want to get flagged. You want to do things right. You want to actually have the right backup and support. So I understand both sides. So when I was in real estate, I just saw an opportunity to bridge those 2 worlds with my background. And I'm an entrepreneur at heart too. So I really love building companies and building things up. And it actually went from I went into real estate to really to be an entrepreneur, to be have my own time and be my own boss. And this was a really good opportunity. And it kind of came full circle. So I do both, and I really love it. I work with CPAs all over the country because I'm not doing taxes. So I'm not competing with other tax CPAs like, hey, we're going to take your customer to, tax prep. I'm not doing that. I'm just doing the cost segregation work, which tax CPAs aren't doing anyways. They can do it, but it's typically on the back end, like a cost segregation firm. They're working with a cost segregation firm.
So tell me a little bit more about self-storage. How does that business work? I understand how it works, but as far as the development world and financing and operational, tell me a little bit about self-storage business.
Self-storage, it's a great asset class because it's simple, it's straightforward, it's not overly complicated to run or to manage. It can be run remotely, managed remotely. You can use technology to manage the tenants and to manage the camera system and the gate and all of that, right? You do need boots on the ground to help with maintenance stuff, but it's just a really good asset class that's simple and straightforward. And you're not dealing with humans like living there. You're not renting to human beings with kitchens and plumbing and toilets and things like that. On the financing perspective, the Small Business Association actually looks at it as a business, not as real estate. So you can get an SBA loan to get into self-storage. So you can go as low as like 10% down. Typically it's around 15% down to buy a self-storage facility. We've done that. That type of financing is not available for apartment complexes. You can't go get an SBA loan to buy residential property. So there's really good financing opportunities that way. Typically, banks, like local banks and credit unions, offer like really good terms too, which is what we've done for the most part. We haven't done SBA, but the development that we did most recently, we were able to buy the existing facility and then include in that loan the funds to double the size of it. So it was mostly an outdoor drive up climate controlled or non climate controlled self storage facility. There was one climate controlled building. We bought it and then we built three more climate controlled buildings to go with it. So there are funds to do that. Banks typically like self storage as an asset class.
Interesting. And are there a lot of, from what I've seen, there seems to be a few large REITs that own and operate self storage facilities around the country. And then there's a few of these mom and pop facilities that look nothing like those big, the big orange boxes that everybody knows. How's that competition working out?
It's tough to compete with the REITs, right? The REITs are typically in the most populated markets, right? Like in the cities and stuff. Whereas the mom and pops are more focused on secondary or tertiary type of markets. And so the REITs have a very strong hold on like, the more populated the area is. Like they have a very strong hold there. But I think it's still like 70% of self-storage facilities overall are owned by mom and pop, 30% are owned by the REITs. But I think as you get into class A self-storage facilities, I would say it's probably more split like 50-50 or potentially even more by the REITs. So they definitely are buying them up. It's hard to compete with them because they're not playing the same game that you're playing, right? In terms of like getting their investors a certain return on their money. They're, they have a stock price and they borrow, I think it's, like, I don't know, you'd say like retirement money, right? And so they only need to get like the return that they need to get versus the return that you need to get as like a small syndicator or a small mom and pop owner is much lower. So they're able to buy at higher cap rates. They're able to be a lot more aggressive. So you really have to get creative. Like you're not going to go outspend them on Google Ads when they have facilities across the country and they spend a ton with Google, right? So um, it's definitely a different game than what they're playing.
Interesting. So for somebody who has a property that's zoned, something flexible where they could put an apartment building, maybe an office building, maybe a warehouse, or maybe a self-storage facility. For multifamily, just because I'm familiar with it, there's plenty of services out there that you could rely on to analyze the supply and demand, to analyze the rental rates. How do you analyze self-storage facilities? How do you know what the market is, what the demand is, what the competition is?
Yeah, so we typically look at the saturation level from um, how many square feet there are per capita or per person. And so, there's ways to get the statistical information like population at a very pinpointed location, right? Like, what is that 3 mile population or that 5 mile population? And then it's kind of looking at it a couple different ways of like, okay, bird's eye view, circular radius. Well, how much square footage is there in the market? And is that high or low compared to the national average, compared to the state average? You could also do it by drive time, like 5, 10, 15-minute drive time, as opposed to just by a straight line bird's eye view. And you could look at the saturation level that way. There's softwares out there where you can get this information. They don't always capture some of the smaller data. It's available like smaller self-storage facilities, like mom and pop own, but they typically capture like the big ones or like the medium-sized ones. So that's something to look at. It's not that there's like a particular, you know, supply per like square foot per capita. It's really just comes down to like, hey, all these facilities are full and there's room to build more, or they're not full and there's way too much supply in the market, right? And that comes down to secret shopping and like going and testing different facilities, calling them, seeing what they have to move in, and you have to try to get an idea of what their occupancy is like to see if there is demand for more. So it's an art for sure. It's not a science.
Interesting. So there's no central service like a CoStar that we use for apartments where you could download this huge data and it'll tell you all the recent sales, cap rates, current rental rates, the dynamics, and all that.
There's some information like that, like store track. That's a good one. I've used that in the past. I like store track a lot. There is a Radius Plus. Radius Plus is a good one as well. And so that will give you a lot of information. It'll give you sales, comps, stuff like that. But at the end of the day, you have all this data, but you have to really determine, it's more of a feel if it truly is, there's truly demand for more or not. If you call around, everybody's completely full, fantastic. Well, then you kind of know like, hey, there is demand for more, or there's saturation levels really low. It makes sense to build here. But um, again, you have to get the feel for the individual market.
Interesting. How long does it take to build a facility? And I guess another question is, what is the sweet spot for the size? Is it 100
Yeah.
unit, 300 unit, 1,000 units, or is it market dependent?
It's market dependent. I mean, once you start a lot of, you know, depends on what your exit strategy is. If you want to sell to like a REIT or something, like you probably want to be at 70,000 square feet or above, like at a minimum 70,000 square feet. If you don't care about selling to like somebody who could pay a higher cap rate, well, then like you can build whatever you want. It's definitely economies of scale though, with building more. It's going to be less expensive on a per square foot basis. How long it takes? Well, that's a great question. It really depends on how long your inspector takes to approve the whole thing. And, we had our development recently. He delayed us 6 months, which is huge. It's a really big thing to delay 6 months of lease up. So it's going to be market dependent. It's going to be dependent on who the people are and the inspector and things like that. So everything goes very smoothly. I would say you give yourself a year always, but like if not accelerated, it would be like 6 months. That is doable.
Okay, interesting. Yeah, because obviously in multifamily, we're looking at least 18 months if inspector doesn't screw us. But typically we budget 2 years, or 2.5 years to build a building from the time the permits are approved, because permitting time could be
Right.
unpredictable as well.
Exactly.
But interesting. And in terms of yields, I'm just curious because I've never done self storage, but in terms of yields, what are you typically expecting as far as yields on cost or maybe return on investment, things like that? Something that LPs, limited partners, investors would be interested in, and just general public might find educational, informational.
Yeah, I think it depends on the risk level, right? Like the riskier the project is, well, then the higher your IRR needs to be, so return on investment needs to be because there's more risk to it, right? So if you're doing like a brand new ground up development, it's unproven, there's a lot more risk there than buying an existing facility and just improving management. So I would say like for the higher risk ones, you're looking more like low 20s, 20+%. Maybe that's 22%. If it's more of a stabilized, it's a facility that's stabilized, you just need to like go improve it, right? Maybe it's more like 18% IRR. The idea is to approximately double your investor's money in about 5 years. Would you say that's
Okay.
similar to
What about yield on?
multifamily?
I mean, similar. When you said low 20s, I'm like, oh, that's actually pretty good.
Right.
Uh, right. What about like yield on cost? Right now, it seems like the benchmark in multifamily for yield on cost to be at least 6% or higher. Nobody wants to even look at a property if the yield is less than 6%. Is there a similar metric that you're tracking in self storage?
Yeah, I don't really tell you the truth. I don't have an opinion on that. Like it's not really a metric that I personally use when looking at it. Look at price per square foot. So it's like what's replacement cost? Well, we know costs $115 to build this facility. Like, right, that's what it would cost us. But we're buying it for $250 price per square foot. Is that way too high? Well, not necessarily. Like, what's the income approach? So you kind of have to look at it from replacement value or cost to build, as well as a profitability standpoint, right? Like from a cap rate perspective. So that's typically how we're looking
Mhm.
at it. And for the investors, it's a equity multiple or internal rate of return.
I remember, must have been like 15 years ago, I was watching this report on CNBC, and they were talking about self storage being a huge growing segment in real estate. And I remember the thing they quoted, I actually never validated the numbers, but they said something along the lines of rent per square foot of a self storage facility was comparable to rent per square foot of an apartment building. But the construction cost is a fraction of the apartment building because there's nothing inside, right? It's just a concrete box or steel box with nominal heat, nominal light, and no plumbing.
Yeah.
And so the argument was that that's, it's a huge market, and obviously the units are smaller, and so that allows them to charge more per square foot. But I remember thinking way back when that why am I messing with apartments when
You should have bought
self-storage
it
seems
all
to be so
then,
much
you
more
know? You should have,
attractive?
yeah, should have bought
Right.
it. Well, I
Bitcoin.
started buying Bitcoin the last few years. Yeah, just it's very speculative, but yeah, it's something I can allocate a little bit of money towards. But yes, I should have done that too, and Apple stock as well, right? Like way back in the day.
Sure.
Hopefully we do those things now, right? And then we say, glad we did that in 10 or 20 years. So never too late to start. We just have to pick, right? We do look at rents per square foot. So let's just say like you have a 10 by 10 unit. I like to be like for non-climate control, like not really, don't really want to look at anything that's like generating less than $1 per square foot in monthly rent. So 10 by 10 rent for $100. Okay, you're at $1 square foot. When it comes to climate controlled, right? Like I think the bottom line is more like $1.50 per square foot on a monthly basis. Let's just say dollars for a 10 by 10 climate controlled. It's about $18 per square foot on an annual basis. These again, this comes down to a lot of other factors that contribute towards this, and like what are you buying at and everything. But if you're looking at a new development, it's not really probably isn't worth your time if you're looking at stuff that's going to be, if they're renting climate control 10 by 10s for $100, $1 per square foot. Well, you're not going to get a great return on your money. As you start checking out deals and looking at more things, you start to learn that. I know guys who are closer to $175 a month to $200 a month, where their starting points are. So the more populated the area, the more demand there is going to be, the more you can push these rates.
Right. Well, I was just going to ask, what area are you primarily involved in? Like these rates that you're mentioning, what's the geography? What's the population like?
Mostly secondary markets, out in the suburbs. That's what, we focus on. I'm not going to go into the city of Chicago or into the city of Detroit. Like that's not what I want to do in the suburbs. That's where I'd want to be. That's where I am.
Yeah, it's interesting because we're primarily in the Seattle area and we're looking at apartments and similar thing, downtown Seattle. Well, it's probably not as high right now where the market is changing, but it's coming back to life now.
Yeah.
But still, we could see easily apartment rates in mid threes. In some cases, smaller units are hitting $5 a foot. But then you go in the suburbs, more rural areas, and it's kind of similar to what you were describing. It might be, $1.50, $2 a foot, especially for an older garden style apartments. But it's that discrepancy is huge between the urban and suburban rural areas.
Agreed.
Let's see. Some of the typical questions that I ask a lot of my guests is, how about your biggest mistake that you ever made, either on real estate investment side or cost segregation side? Can you share something that you learned from and that others can learn from?
Yeah, I think I learned the lesson early on of, not letting cash flow or like hit what pencils out on Excel to allow you to buy like low quality asset. And I think this kind of goes in every aspect of business. So what I mean is like if you're a business owner and you focus just on pricing, you just want to be the cheapest pricing possible, right? And so you're going to compete with everybody. So if you're more focused on quality, you focus on people who are willing to pay quality prices, and you're going to attract customers who are looking for quality. And those customers often pay more, right? And they pay more or are willing to pay you your rates, right? Without the headache. They're not as much of a hassle because they understand what they're getting into. It's the same thing with real estate. High quality buildings, whether it's residential or self storage or whatever, high quality locations, they're going to be easier, less of a headache to actually manage and run and have as investments. I think, I learned that lesson in more the beginning of my real estate journey. And bought a duplex who's in Indianapolis, but it was in a really rough area and had all kinds of problems and had tons of structural issues that I didn't realize. And It was just a bad area. But paper was great. I'm at the 2% rule. I bought it for $70,000 and it was going to bring in rent of like $1,400 a month. I was like, awesome. So I should cash flow like $700 a month in my pocket. Fantastic. But when it came down to it, I couldn't get good applicants. I had squatters. I had like deal with issues. I never got paid rent. I lost just the money. I think I ended up losing about $30,000 on the property. I sold it and just got rid of the headache, right? And so that was one of those lessons that really translated into every aspect of business for me. And in real estate is like, it's not worth the headache to deal with low quality work or asset classes or tenants or whatever it is. Like if quality truly matters, it's going to be a lot less stress.
What a concept. High quality product attracts high quality customer.
Yeah. What do you know?
That's amazing. Excellent. Well, I think based on the way this conversation went, we just recorded 2 episodes. I think we'll have one dedicated to cost segregation and one dedicated to self-storage, because there's really not much correlation between the two. Sean, let me ask you, what else should we be talking? What else did you want to mention? Is there some specific that you would like your followers to hear about?
You want to connect with me? I'd love to connect. We do cost segregation work for everything small, single family rental properties, duplexes, triplexes, all the way up to large commercial, self-storage, large multifamily, office space, hotels, warehouse, whatever it is. Reach out to me. I'll give you a link. So you go to mavencostseg.com/EG. I'll give a discount for your listeners if you're able to add that to the show notes. That way I'll know they came from you and your podcast too. That's a good way to get a hold of me, or shoot me an email, Sean, SEAN at mavencostseg.com, and happy to talk about it. If you want to talk about self-storage too, I'm happy to talk about self-storage. Whatever it is, I'll shoot you my calendar link and we can connect. Real estate development, legacy.